In this video, we're going to be taking a look at adjusting entries and exploring how those work as we prepare for our assignment today. So adjusting entries are basically journal entries that are created at the end of a fiscal year or a fiscal period. And typically these are to correct timing differences between revenues and expenses to help them fall in line with GAAP rules. So a couple of common GAAP rules that drive adjusting entries are the matching principle and revenue recognition. In both of these cases, these rules identify either revenues or expenses and explain when we are allowed to record them on the income statement. So if we have revenues, for example, where we've received the money, but GAAP doesn't allow us to actually put that money on the income statement, then we need to move it off the income statement and put it on the balance sheet for a while until we recognize that revenue. And then we can transfer it back onto the income statement. So in the end, the transfer out and the transfer back will wash itself out, and the net difference of these adjusting entries is zero. The only difference is temporary while we're waiting for the timing of that revenue recognition. And that's why we call it a timing difference, because it's just a temporary difference where we move money away from the income statement until we're allowed to actually recognize it as revenue or expense, and then we move it back. So when you're dealing with adjusting entries, all of our adjusting entries are either moving money off the income statement to the balance sheet, or moving money off the balance sheet back to the income statement. So an adjusting entry will always affect at least one income statement account and at least one balance sheet account. That's the big thing to remember with adjusting entries. Adjusting entries affect an income statement and a balance sheet account because it's transferring money from one to the other or back again. Now, there are a lot of different adjusting entries that a business could make, but there are 7 that are most common. These would include things like revenue recognition, allowance or bad debt estimates, so estimating how much bad debt you might have when you're using the allowance method, prepaid expenses like our prepaid insurance, supplies expense adjustments, inventory adjustments, especially when you're using something like a periodic inventory system where you're making periodic adjustments at typically at the end of fiscal periods. Depreciation expense, and finally an income tax adjustment. Now, as we're looking over these 7 adjustments, you may recognize that many of these are things that we've covered earlier throughout the semester. So things like revenue recognition, bad debt estimates, prepaid expenses, inventory adjustments, and depreciation expense are all things we've talked about before and should already be in your notes. So the only real new adjusting entries that we have are supplies expense and income tax adjustments. Now we're going to look at supplies expense in this video, and then I have a separate video to go over the income tax adjustments. When you're dealing with supplies, up until this point throughout the entire semester, every time we've purchased supplies, we've always debited supplies and credited cash or accounts payable. So this supplies account has been an asset account where we've held all of our supplies because supplies are an asset. But the thing is, over time, you're going to use those assets. For example, if I bought $2,000 worth of paper, throughout the year, I'm going to use some of that paper, and maybe at the end of the day, I only have 1,500 of it left. Well, up to this point, we haven't had a single adjustment to reduce that amount of supply. So every time we purchase supplies, it just keeps increasing and increasing and increasing, and we never recognize any expenses for the supplies that get used up to generate revenue. And so that doesn't fall in line with the matching principle, and that's why we need to fix it. So let's look at an example to understand this a little better. Let's imagine that our company over the year has purchased $1,500 in supplies on their balance sheet. At the end of the year, your company goes in and counts their supplies and checks how much they have left, and they realize that they only have $1,200 in supplies on hand at the end of the year. So we started the year with 1,500, we ended the year with 1,200. So during the year, we must have used $300 worth of supplies, but that didn't get recorded anywhere. So right now on our balance sheet, our supplies account is $300 too high. So we have too much money in our supplies account and not enough money in our supplies expense account. That's the problem we need to correct with this adjusting entry. Now, in the accounting world, we have special terms for this. Whenever you have an account that has too much money in it, we call that being overstated. So we would say that our supplies account is overstated because it has too much money in it. And then our supplies expense account, we would say that it's understated because it doesn't have enough money in it. So those are just terms that you'll see in the accounting world and ones that you'll want to remember. But one of the biggest issues with this supplies entry is right now our supplies is overstated and our supplies expense is understated. So we need to fix that. To do that, we're going to increase our supplies expense account. So we're going to debit the expense for the $300 difference between what our starting inventory was and our ending inventory. And then we're going to reduce supplies by the amount that got used. So supplies is going to get a credit to reduce that asset down to the $1,200. And that's what our adjusting entry for supplies would look like.